Okay, in this video we are going to be talking about hedging as it relates to an index platform which have become very popular with the new stock market highs in 2014. And in this platform you use an insurance company to manage risk. They do this in one of two types of models, a static model or a dynamic model. So the way this works is an investor will give an insurance company $50,000 and another one will give $100,000 and another one will give $1 million and so forth. And within a grouping of over a week or two period of time, the insurance company is going to take that, build a bond portfolio for safety, and generate an interest credit. So insurance companies do this. They do this very well. In today's interest rate environment, they could probably get a portfolio paying them around 3.75%. The insurance company has a 2% spread. That's the cost of running an insurance company, paying for all the brick and mortar employees and so forth, and that leaves a 1.75% interest credit. And that interest credit is what is used to purchase the options up here on the index. So they're generally going to be buying 1-year options on the S&P 500, for instance, and on the static model you're buying on the S&P index and you're just simply 1 year later taking your return. And they have three different crediting methods they're going to use. They're going to use a cap, they're going to use a participation rate, and then they're going to use a spread. Now this spread is different than the spread I talked about over here. This spread is where the insurance company is measuring the volatility and determining a number that will allow them to hedge the risk. And today that number is somewhere between 2.5% and 3.5%. On the participation rate, this means whatever the market does, you get a percentage of it. And those rates, they're down in the 30 to 40% range, meaning if the market goes up 10, you don't get 10, you get 3 or you get 4. And a cap, today's caps are around 4%. Now dynamic, this is where the insurance company is making adjustments generally on a daily basis among indexes, and oftentimes in the ones that we'll talk about today, they're using an equity index and a bond index, and they're doing some volatility rebalancing in between these two indexes. Now there are two questions, and this is the main reason I wanted to talk about this in this video, that people will have as you understand this. The first question is, as it relates to the cap and the spread, if the market goes up 12%, in a cap you're going to get 4, but in a spread you're going to get, let's take the middle here, 2.5, 3.5, let's say 3. So the market goes up 12, you get 9. Well, why the disparity between the spread and the cap? That's one question. And the second question is the upside potential of the spread. So what I want to do is actually look at option pricing of some typical stocks and answer this question that way as an analogy, and then hopefully it'll make more sense to you. Okay, we're going to look at two stocks. Here is American Airlines. I just simply went to Yahoo Finance instead of using the trading platform that we use that is much more granular. This is something you can do on the internet. You can just go to Yahoo Finance and find all this on your own. So American Airlines and the other one we're going to look at is Delta. They're both trading within a couple dollars of each other, and they both have similar earnings per share, and American Airlines does not pay a dividend and Delta only pays like a 0.6% dividend. So they're very, very similar stocks. So let's look at a call option, and again this is trading at $41, $41.62. Here we are in July 14. Well, let's go out to January 15. Let's go 6 months out and look at a call option 12% above this price. So 12% above this stock price is going to be around $45. So let's scroll down here to $45. You can see right here $45 to 3.30. So if we owned this stock and we wanted to sell a covered call option on this. Somebody would be willing, see where the bid is here, somebody would be willing at a strike price of 45 would be willing to pay us $3.30 per share. Now let's look at Delta. Similar price, 12% above 38.60 is 42. So here we are, January 15th, still a 6-month option. Let's go over to $42, and you can see right here $2.45. So if we own Delta stock and we wanted to sell a covered call, somebody would be willing to pay $2.45 in order to buy this stock at a strike price of 42. So $2.45 for the opportunity for Delta to go from $38 a share up to 42, and then they would be able to buy at 42. So obviously they're hoping it goes higher so they make money. So $2.45 versus American Airlines at their price $3.30. So why the difference? Why is someone willing to pay us $2.45 for Delta, whereas someone else would be willing to pay $3.30 for American? Meaning they both think the stock's going to go up if they're buying the call, right? They both think the stock is going to go up, but someone's willing to pay us more for an American Airlines option than they are Delta. Why? It comes down to this word right here. Opinion. Someone has a stronger opinion that American Airlines is going to go up in price than Delta is. Otherwise, these would be at parity, because we saw it, the stock price is within $1 or $2 of each other. Earnings per share is similar. So all things being equal, somebody's saying that this is a better opportunity. Otherwise, they would have bought the call option on Delta. So how does this relate to the hedging on the index platform? Well, as we look at the spread, this spread is a function of the dynamic method, where there's daily movements according to volatility between the equity and the bond indexes. The insurance company's opinion is that they can, in this pricing, let's call it 3% again, in this pricing, that they can manage their risk according to what this 1-year option between these two indexes is going to do over time. If you're not doing anything on a daily basis, you basically have to wait. You have to wait for this 1 year to go by, which is why you're going to put a cap or you're going to put a participation rate on there, because everything, this entire video is about hedging. We're trying to hedge our risk. Well, if you're not going to do anything, then you need to have the cap on a lower threshold, because you're not trying to do any kind of active hedging management. If you're doing it on a daily basis, you can afford to get better pricing, and this is better pricing for you, the investor, better pricing. So that's why there's a difference between this and this. What about the upside? Because someone might say, well, wait a minute. If I'm getting a 1.75% interest credit that's buying me this opportunity right here, this spread opportunity, if the indexes go up 15, am I going to get 15? No, we have to subtract out our spread. So I'm going to get 12. Well, that's not a bad deal. I basically paid 1.75 for a 12% return. Whereas if I had the static, unmanaged hedging, I would have got 4, meaning the market would have been up 15 and I would have got 4. So you say, well, wait a minute, why is this such a good deal, this 1.75, and I get 12? Why am I getting such a benefit over here? And we answer the question down back to our stocks. Remember, American Airlines is trading at $41. The strike price was $45. So this option isn't in the money until the stock goes above 45. But let's say it goes way up. Let's say it goes up to 55. Well, we paid $3.30 a share. We're in the money. We would exercise the option at 45. We have to pay for the cost of our option. But if the price goes up to 55, remember, we exercise the option, we buy it at 45, instantaneously sell it at 55, and make our $10 per share minus the cost of the option. Well, what if, because of all the efficiencies going on with the U.S. Airway merger and so forth, this went to 60? What if it did that, right? Then you made $15 a share. The price of what we paid didn't change. We have a fixed cost of the option. So regardless of how high the stock price goes, It doesn't affect what we paid for it. It's just simply more profit. So back to our position here, we paid 1.75. Whether the market goes up 5, 10, or 15, we are not in competition with the insurance company. We pay our 1.75. Whatever the index's returns are, anything above the spread of 3%, we are in the money. So anything north of here, we're making money. The insurance company doesn't have a dog in the hunt of whether we make 5, 10, or 15. They are just simply managing their risk according to the volatility of these two indexes. So regardless of what we pay, or regardless how high the index returns, the insurance company is not in competition. They are not trying to squelch our returns, because if you think about it, it's in their best interest for you to have positive experiences. The higher the returns are in your index platform, the happier you're going to be, the more you're going to tell your friends, the more you're going to keep your money there, and so forth and so on. So this hedging is really predicated on, is the insurance company using a static, or are they using dynamic model? Are they sitting there and watching the index and giving you a cap or participation rate, or are they doing something on a daily basis in order to manage to a lower spread? The lower spread allows you the potential of a higher return with this fixed cost of this interest credit. Okay, thanks for watching.